We move to the next topic, which is stress testing. And stress testing of bank, it's a topic of operational and integrated risk management system for FRM part 2. Now we need to understand this topic, which is based on how a bank uses stress testing to determine if the liquidity and capital are adequate. Uh, Capital adequacy is one thing that the bank needs to check, and these issues are very similar to the liquidity that we studied. We need to understand what was happening in 2009 and the details of 2009 Supervisory Capital Assessment Program, that is called SCAP. The first stress testing required after 2007-2008 financial crisis. We need to also understand the issue of coherence in stress tanking and describe the challenges in modeling the balance sheet using stress test in the context of stress test horizon. Finally, we'll understand the differences between US and European stress test and the way that stress test methodologies disclosure have changed since 2009. So let's understand what's the meaning of stress testing. Let's try to sensitize ourselves with this. In the wake of 2007-2008 financial crisis, regulators and other policymakers realized the standard approach to risk assessment, such as regulatory capital ratio requirement, were not sufficient. At that point, supervisory stress testing became a popular tool for measuring bank risk. There is a pop quiz quality to the post-financial crisis stress tests. They were difficult to manipulate because they were sprung on bank at a short notice. As a result, the information provided by the stress test to regulator and the market was truly new. This allowed financial market to better understand bank risk and as a result regain a level of trust in the banking sector. The goal of stress testing as well as capital liquidity and economic capital liquidity, that is internal and bank specific model, is to assess how much capital and liquidity a financial institution need to support its business line, and especially when the business line are risk taking activities. It is relatively easy for banks to swap out lower risk asset into higher risk assets. Stress testing provides clarity about true risk and soundness of banks. Stress testing is an old tool that the bank and the other firm have used to examine risk. It asks the question, what is the institution's resilience to deteriorating condition, and simulates financial results given adverse scenarios. Stresses are generally of two basic types. The first is scenario, or the next is sensitivity. For example, a scenario is a severe recession. An example of scenario is a significant increase in interest rate risk. The risk manager can stress the sensitivity of a single position on a loan or an entire portfolio. Now we'll look at what is SCAP. It's also known as Supervisory Capital Assessment Program. So the difference in the feature and the scope of stress test before and after the Supervisory Capital Asset Program is what we are going to look at. In the wake of the financial crisis, there was much uncertainty about the soundness of US banking system. Regulators need to assess the capital strength of the financial institution. If there was a gap between bank needed in terms of capital and what it had, regulators had to find a credible way to fill this hole. In 2009, bank stress test known as Supervisory Capital Assessment Program was meant to serve that purpose. It was the first macro-prudential stress test after 2007-2008 financial crisis. Macroprudential regulator focuses on the soundness of the bank system as a whole and focuses on systematic risk, while prudent regulation focuses on the safety and soundness of individual institution. Now at this point, the federal government planned to infuse equity capital into the bank that was under decapitalized based on stress testing. The Treasury intended to borrow and downstream it as the equity in the bank via Treasury Capital Assessment Program, which is TCAP. The bank could not convince investor to fill the hole, that is infuse bank with the need of equity capital. Current investors would be diluted by the government's equity investment. In the end, 19 SCAP or 19 Supervisory Capital Assessment Program banks were required to raise 75 billion within 6 months. The undercapitalized bank raised 77 billion on the Tier 1 common equity and did not need to draw on Cap 1. So if you remember, we look at Tier 1, Tier 2 equity, and the bank were required to raise 75 billion and they did that. and there were 19 banks. Now, I saw a movie. I think it was the last day of Lehman Brothers, which is based on this story where the Federal Reserve and the Treasury Secretary had to jump in and convince the banks to actually go ahead and sign this bill. You can check that small movie. I think it's an HBO production, but I'm not sure of. Okay, prior to 2009, stress testing was relatively simple. Uh, the difference in stress testing pre-SCAP and post-SCAP could be described as five. Now let's look at them one by one. The first is primary assessment exposure to single shock uh, was used in the pre-SCAP, which is like volatility increases, interest rate increases, and there is an OR button between them. Whereas post-SCAP consider Brock macro scenario and market-wide stress, multiple factors changing at once, which was evident in 2008 crisis. The next is focus on specific bank products or business line. While post-SCAP, the focus was on whole firm, a more comprehensive look. Then we have typically focused on earning shocks, but not on capital adequacy was the pre-SCAP, but the post-SCAP was explicitly focuses on capital adequacy, considers the post-stress equity threshold to ensure that a bank remain viable. Pre-SCAP focuses exclusively on losses, post-SCAP focuses on revenues, cost and projected losses. Stress testing was static in nature, stress testing is now dynamic and path dependent. Now challenges with coherence is our next topic, and we need to understand the problem of coherence in modeling risk factors during the stress testing of banks. One of the challenges of designing useful stress test is coherence. The sensitivity and scenario must be extreme but also reasonable and or possible, that is coherent. Problem are inherently multifactored, making it more difficult to design a coherent stress test. For example, an increase in volatility can lead to credit market freeze. High unemployment or falling equity prices often go hand in hand. It is not sufficient to specify one potential problem because others don't remain fixed. The supervisory key challenge is to specify joint outcome of all relevant risk factors. Additionally, not everything got bad at once. For example, if some currencies are depreciating, others must be depreciate. If there is a flight to quality, there must be a safe havens in the stress model. So while it is important to look at, for example, what happens in US Treasury debt become riskier if no longer safe havens, the model would at the same time have to identify the risk-free asset which the capital would flee under those circumstances. The problem is even greater when designing stress test scenario for marked to market portfolio of traded securities and derivative. Risk is generally managed with a value at risk hand. Hundreds and thousands of positions in the trading book must be mapped to thousands of risk factor tracked on a daily basis. The data that results in the use to estimate volatility and correlation parameters. It is very difficult to find coherent outcome in such complex multi-dimensional universe. In 2009, SCAP tested rather simple scenarios with three variables: growth in GDP, unemployment, and the housing price index. Historical experience was used for market scenario. Example: financial crisis, a period of flight to safety, the failure of Lehman, high risk premium, and so on. While the market risk scenario did not test for something new, the overall framework achieved coherence of financial and other stress tests of the time period. One thing to note that prior to 2001, all supervisory stress tests imposed the same scenario on all banks. That is one size fit all approach in testing. In recognition of the problem, 2011 and 2012 Comprehensive Capital Analysis Review, which is CCAR, asked banks to submit results from their own stress testing in addition to supervisory stress testing in an attempt to reveal bank specific vulnerabilities. It is an important step forward for 2009 SCAP as it gives supervisors a sense of what a bank think are the high risk scenario. This provided regulators with not only bank specific, which is the microprudential insight, but also provide macroprudent supervision as it highlighted risk across banks that have been underemphasized or unnoticed before. Now challenges with mapping risk factor. Now there are various challenges in mapping risk factors from a broader macro factor to a specific intermediate risk factor in modeling losses. Current stress tests are based on macro scenarios which are unemployment, GDP growth, housing price index. One concern is how to translate the macro risk factors employed in stress testing into micro outcomes relevant to revenues and loss. Supervisors need to map macro factors into intermediate risk factors that drive losses in specific products and geography area. Although not limited to these products, geographical differences are especially important in modeling losses in both commercial and residential real estate lending. Credit card losses are particularly sensitive to unemployment figure. For example, unemployment was 12.9% in Nevada in July 2009 and 3.3% in North Dakota, and the national unemployment rate was 9.1%. Credit card losses vary dramatically from region to region during this period. The geographical diversity with respect to macro factors make one size fit for all stress testing less meaningful. Geography is not only the different supervisor must contend with. Risk affects different asset classes in a different way. For example, during recession, people buy a fewer automobile. However, if a person needs a car during a recession, he is more likely to buy a used car. Therefore, if the default risk increases, the loss given default may not increase as much. The business cycle also affects difference in different industries at different times. Consider the airline industry versus the healthcare industry during the recession. Airplanes are collateral for loan to airlines. If the airline industry is depressed, the bank gets stuck with collateral that is difficult to sell except at extremely depressed prices. Healthcare is somewhat recession proof but does not mean that the bank can transform any plane it is stuck into a hospital. This factor increases the difficult mapping broader macroeconomic scenario to bank specific risk challenges. Now we move to the next topic, which is challenges with balance sheet modeling. Now balance sheet over a stress testing horizon period is very challenging. The typical stress test horizon is 2 years. Over this period, both income statement and balance sheet must be modeled to determine if the capital is adequate post stress. Generally speaking, capital is measured as a ratio of capital to assets. There are different types of capital, tier 1, tier 2, but in general and for the sake of simplicity, capital is defined as a common equity. Risk weighted assets are computed based on Basel II risk weight definitions. For example, agency securities have lower risk than credit card loan. In a stress model, the beginning balance sheet generates the first quarter income and losses from the stress scenario, which in turn determine the uh, quarter end balance sheet. At that point, person modeling the risk must consider if asset will be sold or originated if capital is depleted due to other actions, or as a result of spin-off, there are changes made in the dividend policy, or if the share is repurchased, and so on. And these are different things that could happen. These decisions makes modeling the balance sheet over the stress horizon more difficult. The stress model does not determine if it would be good time to sell subsidiary or lower the payment. So now we move to the challenges of balance sheet modeling, which exist both under static and dynamic modeling assumption. The bank must maintain its capital ratio during all quarters of the stress test horizon. At the end of the stress test horizon, the bank must estimate the reserves needed to cover the losses of loan or lease for another year. This means that the 2-year horizon stress is actually a 3-year test horizon. That is, T-year stress requires to estimate T plus 1 year losses. Now stress testing comparison is our next topic, and it says that compare and contrast 2009 SCAP test, the 2011 and 12 CCAP, and 2001 EBA Irish and EBA European stress test methodology and key finding. Disclosure was a significant feature of 2009 SCAP. It disclosed project for each of the 19 participant banks for 8 assets. It also disclosed resources the bank had to absorb losses other than capital, that is pre-provision for net income and reserve release if available. If high level of disclosure created transparency, it allowed investors and market to check the severity of stress test and comprehend stress test outcome at individual bank level. Before 2009 SCAP, the bank only reported realized losses, not the forecasted losses, which is a possible losses due in the stress scenario. In 2011 CCAR, it required only the macro scenarios to be published, not bank level result. This differentiated dramatically from the 2009 SCAP requirement. The market had to figure out whether a bank passed the test or not. Market participants had to do the math themselves. For example, if a bank increases its dividend, it is assumed by markets to have passed the stress test. However, if 2012 CCAR disclosed virtually the same amount and details of a stressed bank level as 2009 level, that is bank level loss rate and losses by major asset classes. The regulatory asset classes are 6, and I'll read out 1 to 6. First and second line mortgage, commercial and industrial loans, commercial real estate loans, credit card lending, other consumer loans and other loans. One of the key contribution of CCAR was that in both 2011 and 2002, the CCAR required banks to submit the result of their own scenario, both baseline and stress, not supervisory stress test result. So the Fed also reported dollar pre-provision net revenue, which is known as PPNR, gains and losses on available of sale and held to maturity security, and trading and counterparty losses for 6 institutions with largest trading portfolio. These firms were required to conduct trading book stress test. The number that they reported were supervisory estimate, not bank's estimate of the losses under the stress scenario. In contrast, 2011 European Banking Authority Irish and 2011 EBA European wide stress test, both disclosed after the CCR, contained considerable detail. In the Irish case, the bank contained a comparison of the report contained a comparison of bank and third-party estimate of losses. The EBA data was available on electronic downloadable form. Irish needed credibility, having passed the Committee of European Bank Supervisor stress test in July. Only need considerable 4 months later. In general, faith in European supervisory was harmed, and only by disclosing detailed information on bank by bank and asset by asset, country by country, maturity bucket basis could the market interpret the data and draw its own conclusion about bank risk. So there are some results on the comparison of macroprudential stress test, and the key benefit here is the greater disclosure and transparency. Transparency is especially important in the times of financial stress. However, during normal time, the cost of disclosure may outweigh the benefit. For example, the bank may window dress portfolio, make a poor long-term investment decision to increase the likelihood of passing the test. Trader may place too much waste on public information, including a stress test disclosure, and be disincentivized to produce private bank about financial institution. This harms the information content of market prices and makes price less useful for bank regulators. One thing to note is that prior to CCAR, all supervisory stress tests impose the same scenario on all banks, which is one fits size all approach. In recognition, 2011-2012 CCR asked bank to submit results from their own scenario test to the supervisory stress scenario in an attempt to reveal bank specific vulnerabilities. So I'm going to read down again the important points here, and then we'll move and compare the macroprudential stress test. Now, disclosure was a significant feature of 2009 SCAP. The high level of disclosure led to transparent and allowed investor and the market the ability to check the severity of the stress test and the outcome of the stress test at individual bank level. In 2011, CCR required only macroeconomic to be published, not bank level, which differed from 2009. The 2009 CCR disclosed virtually the same amount of detail the bank gave in 2009 SCAP. The EBA Irish and the EBA European required significant disclosures as well. The disclosure were needed to increase trust in European banking system. In the stress model, starting balance sheet generates the first quarter income losses from the stress scenario, which in turn determine the quarter end balance sheet. The bank must maintain its capital liquidity ratio during all quarter and the stress test horizon, typically 2 period. Current stress tests are based on macroeconomic scenarios, GDP growth rate and HPI. One concern is how to translate macroeconomic factors into micro, which is the loss of revenue losses. Supervisors may be able to map from macro factors into intermediate risk factors and drive losses in specific products and geographical areas. So I now move on to the comparison of macroprudential stress test, and I'll start with the last one, and we'll move I'll start with the latest one rather and move on. So what was the stress test? EBA Europe 2009, formerly known as Committee of European Banking Supervision, 90 European banks were stress test. Now what was the methodology? The methodology was 8 macro factors: GDP, inflation, employment, commercial real estate price index, shorter term government rates, stock futures, and so on, and for each of 25 countries. They specified overall 70 risk factors for trading books. It imposed severe haircuts across 7 maturity buckets. Now what was the disclosure that they made here? Bank level projecting losses, comparison of exposure by asset and geography, and data is electronically and downloadable for all. 8 banks were required to raise 2.5 billion, and this was the finding. So these were some of the comparison of the macroprudential test, and this was the chapter stress testing banks, FRM part 2, operational risk. I hope this added something to your current knowledge base, and it was useful. Thank you for listening.